Welcome to From Stuck to Scaled, growth strategies for small and mid-sized businesses, your guide to navigating growth, transformation, and success in today's ever-changing business landscape. Each week, we'll dive into proven strategies, real-world case studies, and actionable insights designed to help small and mid-sized business owners scale smart, lead stronger, and grow faster. Let's get you unstuck and on the path to sustainable, scalable success. Now your host, Julio Gonzalez.
Welcome back to From Stuck to Scaled. I'm your host, Julio Gonzalez, and today we're diving deep into a topic that's crucial for every ambitious business owner: financial clarity and strategic scaling. Many businesses reach a point where they feel like they're treading water, stuck in survival mode without a clear pathway forward. But what if I told you that the key to breaking through that ceiling lies in understanding your financial systems and leveraging them for growth? In this episode, we'll explore how to transform your financial approach from reactive to proactive, empowering you to focus on sustainable growth. We'll discuss essential strategies for increasing profitability without merely raising your revenue. Today's guest is Ryan Kimler, the founder of Net Profit CFO and host of the Net Profit podcast. Ryan has made it his mission to empower business owners with the financial clarity they need to thrive. An international best-selling author, he combines his deep experience in accounting and financial strategy to help companies transition from mere survival to sustainable, profitable growth. With a focus on delivering consistent cash flow and supporting owners in achieving their personal and professional goals, Ryan's insights are invaluable for any business leader looking to break through growth barriers. Today, he's here to share actionable strategies and metrics that can transform a stagnant business into a scalable powerhouse. And let's welcome Ryan to the show. Hey, Ryan, it's good to see you.
Yes, good morning. Thank you for having me on the show.
I am so glad to have you here. Tell our listeners a little bit about yourself and your business.
Sure, absolutely. Well, today I'm located in the greater St. Louis area, and we work with clients all across the country. I've got a background in accounting and finance, and today we work with business owners on their finances and really be an advisor to them. We come in and act as their part-time CFO, helping them grow the business, helping them improve their numbers. A lot of business owners that we work with see higher profits, more cash flow, and more take-home pay for the owner. We help them really put some financial structure into the business, especially as they've grown it, maybe trending towards that $1 million in sales mark or beyond. So we really come in and be that financial expert for them so they can take that off their plate. I've got a small team that works with me as well. So that's a little bit about me, a little bit about the business, and how we work with small business owners.
And Ryan, we've spoken before, and going through your intake form, we're both all about scalability, scaling the business. When does that founder call you and why?
Yeah, a lot of times I'll give you a couple reasons. Number one, they're getting ready to make that first hire. And maybe that first big hire, sometimes, jobs that are six-figure jobs, and they want to make sure that they get it right. Financially, that can be a lot to take on. So that's one of the things. And then as you trend towards $1 million, you're just going to run into some things with scale, right? Kind of what got your business to that point, maybe very dependent on the owner wearing a lot of hats. Maybe won't take them much beyond that $1 million mark. And so they're going to start to face some challenges. And if there's inefficiencies in the business where we're not as profitable as we could be, then a lot of times that's where we get that phone call as well. And they want us to come in and really help them fix those things so that they can scale and grow to the next level. And the third reason that I'll give, and this one is really common as well, if a business has a really, really good year 2 years ago, profits are strong, the owner took home good money, we added good money to the bank, that feels really good, we had a great year. And then maybe last year, the numbers were not the same. Things were down. And a lot of times, in business every day, there's hundreds of things we could be doing, and there's lots of decisions to be made. And figuring out, okay, well, what decisions was it throughout the year that I made that all of a sudden caused me to have a down year can really be a lot to piece together and figure out. And so a lot of times I think business owners get this gut feeling of something's not quite right in the business after they've had a down year, and they're not exactly sure what it is. They can't exactly put their finger on it, which is totally understandable. There's a lot of data to go through. And so a lot of times that's when we'll get that call, and they'll bring us in to, go through that data and figure out, well, here's what changed 2 years ago to last year. And we'll go through that with them and figure out, well, now that we've pinpointed what changed, what decisions do we need to make this year to get back to a better year?
And I wanted to touch on, you talked about, and I lost the words there, but I think it was efficiency. How do you determine that they have an efficiency problem, right? Because in the conversation that we've had in the past, that I've had with other, CFOs and accountants and so forth, you get called in first, right?
Yeah.
So, what do you see that you say, hey, founder, you really have an efficiency issue in your, product delivery. So what is it that you see?
Yeah. So for our firm, we work with a lot of professional service businesses. So, what I'm about to say might not fit with like manufacturing or something like that. So take it with a grain of salt. But, the business itself has got to be producing profits. And for professional service firms, I think you're really efficient when you're in that 20 to 30% range, meaning, just some round easy numbers here. For $1 million business, our profits are $200,000 to $300,000. Now that's going to be after the business owner is on a salary as well, right? So we've paid the bit. I'm not saying it's a great, like strong, like CEO salary. I'm not saying that it's that, but it is probably, for $1 million business, a 6-figure salary or something close to it, 80, 90, $100,000. And then we have $200,000 to $300,000 in profits after that. And for a lot of business owners, that might sound really, really high. But I think what's really important for small business owners and mid-sized companies to understand is there's a lot of transactions that take place in between what our profits are and what actual cash is going to be in the bank. And one of those big ones is taxes, right? So out of the 2 to 300K, after you make that, you've got to turn around and go pay taxes, and that's going to be money out of the bank. So there's a lot of transactions that happen between those profits and that cash flow. And, it's really, really important that as a business, you produce a positive cash flow, not just positive profits, but you've got to have positive cash flow, because if you run out of cash, you're going to be out of business. So that 20 to 30% for professional service firms, that's where I'm seeing that we're efficient, and it also makes it worth it to grow.
Sure.
I always ask a business owner, I think to anybody, $1 million in sales is a lot of work, right? We've got more clients to deal with. We've got to hire more staff, and we just have more things to manage, deadlines to manage, things like that for our customers. And, worrying about customer service, things like that. If we're going to go add $1 million worth of work, are we keeping a number that's worth it? Right. And to me, that $200,000 to $300,000 is, yes, that's worth it. Right. If you're a business that, well, on $1 million, I make 80, okay, 8% profits, right? That's a business that I would consider inefficient. Is it worth it? Right. Or all the headaches that you're going to go through and things like that. We all know that in $1 million of sales, there's probably some difficult customers in there. Right. So, again, before we scale, let's ask ourselves, are we profitable and are we efficient the way that it makes it worth it to scale?
So you just threw out a lot of little tidbits there.
Sure.
So I'm going to ask you to talk about KPIs, right?
Okay.
Because you touched on a couple of them in there. So elaborate a little bit on what some of those important KPIs are and at what level, right? Because the founder who's at $100,000 is going to have different KPIs from 500,000 to $1 million. So what are some of those KPIs and how do you see that evolution taking place?
Yeah. So KPIs, key performance indicators, these are the numbers that are not necessarily directly in the financials, but they are the drivers behind how well your business does. One of them that is in the financials that I want to start with, because I think all business owners should track it, is what are your net profit dollars and what is that as a percentage of revenue? So just like I talked about before, $1 million in sales, 20-30% in profits, right? Again, tracking that percentage, it's kind of like an efficiency score overall on the business, right? And obviously, the higher it is, the more efficient we're being, the more profitable we're being. But I don't care if you're a business that's doing $100,000 or $10 million. That's a number that I would always watch, both on a quarterly basis, monthly basis, for the whole year. You can watch it year over year, but always watching that number tells you how efficient your business is. The second one that I'll give is payroll dollars and payroll percentage. So a study from Forbes Small Business came out end of last year, so end of 2025, that labor in the average business is 70% of revenue. Right now, if you think about that, with the numbers that I gave, that an efficient business is 20 to 30% profits. If we're 70% labor and we haven't covered our marketing costs, we haven't covered our overhead costs, that's going to be a problem, right? You're not going to have 20 to 30% left over if labor is 70%. So tracking your total payroll dollars, and I like to include everything, right? It's the 401k, it's the healthcare, it's the wages, it's the taxes. If you have workers' comp insurance, you could throw that in there, that cost in there as well, right? Really get and capture everything that it takes to pay your people. And then again, work that as a percentage so that we can see where do we stand. If you're 50% payroll cost, you're getting a 2x return on your people, right? That's a great way to look at it. If you're 33%, you're getting a 3x return, right? So that obviously maybe doesn't go for the $100,000 business owner. Maybe you haven't hired yet, but once you make your first hire, then I would say that that's a KPI that you want to start tracking. So maybe that's more your $300,000, $400,000, $500,000 business owner and up. And then the next KPI the third KPI that I'll give, and then I'll kind of wrap this short segment up, is I love to look at pricing. How are we priced? And then really track that through and sit down, do an exercise, figure out when I sell X product or X service, how much are we making every time we sell it, right? And I would encourage business owners to really sit down and do that for all of their products and services. Where it can become a little bit tricky is allocating an overhead portion to it. But I would just use some round, even numbers. Really, again, look at your invoice volume and look at your pricing. Those two super, super important. Julio, we've sat down with businesses and we've kind of taken a dive into that process with owners. And unfortunately, we found products and services before that every time they sell it, they lose money. By the time you factor in the marketing costs, the labor that goes in to do it, I mean, it's just, it's unfortunate, because if you don't get down and kind of look through all those numbers, you could run yourself out of business, right? If you want to scale and continue to grow volume, you're just going to lose more and more and more and more. So going through and evaluating those things at all levels of business, I think, is super important. And if you can get that done at a minimum on an annual basis, I really, again, depending on how the economy and the environment changes, would really love for business owners to do that twice a year, once every 6 months. Again, especially now we've had volatile environments the last couple of years, right? Inflation, war, right? Gas prices, like all that kind of stuff can really affect what your costs are and what goes into delivering your service sometimes. So again, if you can do it every 6 months, it'd be awesome.
You'll hear me talk a lot about process maturity, organizational maturity, and that's why I was asking on the KPIs, because at every stage of business, there are different requirements, right?
Yep.
And early on, I think your finance requirements are probably your most important ones because you're just getting off the ground, right? You're
Yep.
not going to have a lot of KPIs to really measure around your marketing, potentially around your service delivery. So, the finance KPIs to me are the most critical when you're just getting started. And I would argue that, available cash is probably one of the most important ones, right? Because if you don't have cash available, you probably can't, deliver on your business.
Sure.
Um, so one of the things that I look at, longer term, is the service delivery cycle, right? How long does it take you to deliver on your services? So how do you integrate maybe into that, side of the life cycle from a finance perspective?
Yep. So if we've got, I think all businesses really need a great CRM, customer relationship management software. And in there, a lot of them have opportunities to make custom fields and track, any field you want to, right? Um, love for no matter what industry you're in, track the day that you started service with the client and track the day that we ended, right? So in a law firm, let's just say an estate planning firm, right? We can track the day that we signed the client and we can track the day that we signed our estate plan and it's a closed case,
Mhm.
right? That would be a good example. Or, there's some other industries like HVAC or dental that are probably going to be, one day, uh, services, right? Like it's potential, it's more than one. But if you're an HVAC company and you just go out to a house and, change the filter, do a normal checkout, that's just going to be one day, which is fine. And in that case, you might want to go more of tracking the hours and track
Sure.
the time that your technicians got there, time that they left, time that they spent, those kind of things. But I always call that the open and close of open a business and close a business, right? And what's our timeline in between? And Julio, like to your point, I think that gives you so many insights, both because then on the marketing side, right, on the staff capacity side, how much can we handle? How long is it going to take? So that's what I really love to get in there and track is, and again, if with the CRM, if we can tie it to a timeline per product or per service. And then the other thing that you have is if you're tracking your open dates, we can look at, well, what's current? What's
Right.
currently open, especially if we've got something that's longer ongoing, like an estate plan, right? So we can kind of look at how is our staff capacity right now with what we have open. So open and close dates, critical, right? And if we're tracking it, especially, again, I'll go back to a estate planning firm because it's something that takes longer. Let's say our number of open files is increasing. Maybe our staff is behind. Maybe they're overwhelmed, right?
Sure.
If our number of open files is increasing and if our timeline is increasing, right? Maybe it's we used to close one in 2.5 months or 8 weeks or whatever, and now we're closing in 10, right? Those are the kind of things we can look at and really evaluate. Sometimes it might just be, well, it's summertime and everybody's gone on vacation, so we're having a hard time getting the client in, right? But those are the questions you can start to ask when you have that data. So that's what I love to put together.
So you're listening to the From Stuck to Scale podcast, and we're talking with Ryan Kimler around scaling the businesses from a CFO perspective. So Ryan, talk to me a little bit about bottlenecks. What bottlenecks do you see when you go into some of these businesses, and how do you help the founders get past those?
Yep. So one of the biggest ones, a lot of times, again, when they hire us, a lot of times we are the first really finance person that's looking forward. So a lot of times they've got a bookkeeper, they've got a tax preparer, but all of those things really look backward. And so I think one of the big bottlenecks is just having financial clarity to be able to really, look at the numbers, evaluate the numbers, and figure out what's important for me to work on next. right? And for each business, that can be different things. But I think it always seems to come back to delegation, always. And one of the things that we do is after we evaluate the numbers and we have a scoreboard with our clients, then we help them, dive into a specific number and build an action plan around that number. And one of the things that we're always pushing to do is in that action plan, we've got an owner column of, if we have overdue receivables and, someone needs to make phone calls to the clients, who is going to own that responsibility? And we're always pushing that it's not the owner all the time, right? That especially if they've hired, right, they have employees, they've got to get their team involved. It can't all be on them.
I'm glad that you mentioned delegation, because I'm always talking about helping founders really structure their business effectively. And to me, one of the direct translation is having proper documentation, process, and procedure. Because you can't delegate if you don't have the documentation available. And you don't need a 50-page document, but you need some sort of documentation back to the maturity conversation, right? If it's 10 bullet points, these are the 10 things that you need to do when following up on blah. You give that to somebody and they have at least some sort of framework to work off of to do their job. Because if all you're doing is saying, hey, Ryan, go off and collect money, how do I know that you're doing your job effectively? And inevitably, that founder ends up upset because you called somebody you shouldn't have, said something you shouldn't have. And then, oh, Ryan doesn't know how to do his job. No, you don't know how to set proper expectations. You don't know how to delegate. So that's something that I am always hounding, my clients on, and anyone that I talk to, is without that documentation, how on earth are you able to effectively delegate?
Yep. And a process that gives them an idea of, this is what success looks like. Here are some things to avoid, right? Here are some things that are kind of a trap that you could fall into, right? I think those are, yes, good things to have. I don't get into the details on that side of it like you do, but yes, I agree with you. Got to have that, and that's an important piece of the delegation.
That's why you need to call me.
Yes.
So talk to me a little bit about how a fractional CFO helps in that scaling. I mean, you've touched a little bit on there, expand that a little bit more.
Yeah. So one of the first processes that we start with our clients is we're going to build out an annual plan financially. And that really goes top to bottom. And when I say top to bottom, I'm talking, what are we going to sell, all the way down to what is the final cash in the bank going to be? And where are we headed? What is the vision, right? And we're going to start with 1 year, and then we'll move to 3 years and 5 years down the road as we fix some of the more important problems first, but then we'll get to 3 and 5 year. And having that financial plan and looking at the business forward for several years down the road really brings out some of the roadblocks that are in the way for scaling. Because we can see in the numbers, well, what we're doing right now, that's not going to work, right? A lot of times, two questions that I always ask. Number one is it profitable? And number two is it scalable? Those are always two questions that I ask around things when we're making decisions. And again, really having that longer term picture of, well, if we're looking 5 years down the road and looking at, next hires and things like that, we're also going to see the cash flow that happens along the way. And if we have months where we've made a new hire and we're not making money, we know how much cash we've got to have on hand stashed away to really overcome that period. Mm-hmm. But before we do that, we've got to make sure that it makes sense. And that's where, from the finance side, we're going to help you. It definitely takes money to grow, and we're going to help you scale and grow in the right way, in a way that doesn't put you out of business. Because there are a lot of businesses that they grow themselves out of business. The investment for the next piece of equipment or whatever becomes too much, and you can grow yourself out of business.
When you're working on these plans with founders, is there a typical, I mean, and nothing in the world is typical or unique, right? But is there a typical thing that you have to tell a founder, you really need to stop doing this?
Yeah. I would say, the number one thing there, a lot of times it comes down to their personal life. You know, a lot of business owners that we start working with just don't have a regular schedule of what money we're distributing, right? I like to say we kind of ride the roller coaster a little bit, right? We do a bunch of work and maybe we do a big project and we get a lot of money in. So we pay ourselves a lot of money, right? And then maybe we go for a while and that doesn't happen. And so we're down in the bottom and we don't pay ourselves much, right? And so, kind of doing bank balance accounting a little bit, right? What's in the bank? Am I having a good day or not based on what the balance is? That's not a system, and that's not something that I want owners on, especially when you trend towards having $1 million business or $1 million business and beyond. And so, again, part of the annual planning is figuring out, what's your goal to take home, right? You started this business, you're taking on the risk. What kind of a number are you really happy with? If we combine your salary plus a distribution, what number, and you got to factor in that part of the distribution is going to be to pay taxes. What number do you want in your pocket, right? At the end of the day, at the end of the year. And then we set them up on a regular distribution schedule because that's going to keep your personal life more consistent, right? There have been times with partnerships that I've seen, like one partner just doesn't have their personal life financially in order, and that can wreck a business. As a business owner, it is a challenge. You've got two financial houses you got to keep in order, and having consistency, I think, is more than half the battle. And so, if we can get them to a regular salary that pays ideally most of their bills, and then they're distributing for additional money to invest, go on vacations, things like that. That's really, really super important. And then, if the business does well, we can always bonus at the year end, right? We can always make it more if the business does well, and that's what you want to do. But at least getting you on some sort of schedule, super, super important. I would say that's the biggest thing. Second thing is just not taking vacations, I would say. And I'm a business owner. I get it. Sometimes it can be hard, but that really comes back to delegation and depending on others. And sometimes, taking a week vacation could be a real benefit because it brings up, well, what are the challenges and problems that we had? What do we need to dive in and fix, right? So yeah, too many times I see business owners that don't take a vacation in 2, 3, 4 years, right? That really takes a toll just on you from a stress standpoint, from I have to be here around the business standpoint, but also takes a toll on families too, and marriages and things like that. So, go take a vacation, right? And it doesn't have to be, we spent $15,000, right? But go take a week and take it away from the business. Not just I changed my office scenery to the beach, right? Where you have your laptop and you're answering a ton of emails on the beach, but really take it away from the business. Those are a couple of things that I always tell owners.
We've talked a lot on the podcast about succession planning, and your point on vacations is, on point, because if you are not able to step away, how's the business, going to succeed? And too many business owners don't think about succession planning. The founders that have been in business for some time, I'm going to leave the business to my kids. Your kids don't want the business.
Mm-hmm.
The vast majority of businesses in existence today, the families of the founders do not want the business. And I don't know if you've heard this statistic as a financial individual yourself, but 70% of CPA firms in the country are being run by individuals who are 70 years old or higher.
Interesting.
So what's happening with all of those organizations who's, the kids don't want the business, and I understand there's a big consolidation push, with private equity companies, but that all falls into that same conversation.
Yeah,
I'm-
actually, I
but
saw a stat from Forbes here recently on generational businesses.
Mhm.
Even if it does get past the family, second generation fails at 50%. Third generation fails at 92%. Now, you think about those numbers, and I think it just shows the differences, right? Whoever opened the business originally probably had a different passion level for it and for doing it than second generation that it got put on, and then definitely than third generation, right? And so, I mean, even second generation failing at 50%, right? I mean, like you're saying, kids don't want the business, at least half the time, right? Because it ends up, failing and
Yeah.
closing. So, I mean, you're spot on. And the 70% ownership number I had not heard, but that's very high.
Those are crazy failure numbers. So for
Mhm.
anyone listening, if you've got a business, plan better about what to do with your business. If you want to leave a legacy for your family, sell it at a great, rate and leave them the money, because chances are, based on the numbers that Ryan just tossed out, they're going to run the business into the ground, which is crazy.
Yep.
So, Ryan, as businesses look to scale, they will be adding individuals to the organization. So, how do you advise your clients on hiring, who to hire when, what order, what level? Because again, in
Yep.
the maturity, not everybody's going to fit at every stage of the business. So, how do you advise your founders on hiring?
Yep. Absolutely. So, as your business gets to six figures, I recommend that you hire a bookkeeper to take that entry part off your plate. I think it is important as a business owner. You should bootstrap it to there, and you should do it yourself, right? You're not an accountant, but the volume should be low enough that you can manage it, right? And then you're going to learn some things about how it should be, and you're going to learn, if there's something, that's not quite right going on, you're going to know it, right? So you get to six figures, you should hire a bookkeeper, and it doesn't, obviously that's not a full-time person probably, right? It's a person that you pay hourly to get it done, or an outsourced firm, right? Accounting firm that, does bookkeeping, that'll do it, maybe even flat rate monthly. It's not a family member. It's not your spouse. Those are always disclaimers that I say. They're not accountants either, right? So $100,000, hire that bookkeeper. And then if you've passed $100,000 in business, definitely make sure you're working with a good tax preparer, right? Before $100,000, you're probably just a simple, 1099 Schedule C. It's probably not super complex. You can probably H&R block it or something like that, or handle it yourself, right? But once you get into six figures, start to go find those professionals to add to the business. And out of the $100,000, on the bookkeeping side, you might spend a couple $1,000s for the year, 2, 3,000, 4,000, something like that. And on the tax preparing side, you maybe spend 1,000, right? So for a few $1,000s, you can really put some financial professionals in your life to really help you with this. And, I always like to talk to business owners about the opportunity of what can you go sell while you're not doing your bookkeeping and not doing your taxes. I guarantee you can go sell more than $5,000 worth of stuff, because that's most of the time, if you're an owner, that's what's in your wheelhouse, right? Some sort of service or selling, right? So you're going to make that money back. And then, as you scale, as you get, more towards 250, 300, 400, this is really important. I think a lot of people miss it. You want to add a good retirement advisor. I'm not saying they've got to be like a financial planner or any specific organization. I've got a business owner that I work with that has a retirement advisor that just gets him into real estate deals. That's what he wants to be in. That's where he wants his retirement to be. So that retirement advisor, they don't do life insurance at all. They're a specialist in finding real estate deals. So my qualifications here are always, it's got to be somebody that you trust, that you've built a relationship with, and it's got to be investments that you're comfortable with, things that you know about, things that you know how they work, right? If you know nothing about crypto, don't go invest in crypto, right? So those are always my requirements, and it might take you some time to find someone that you trust and build a relationship with. So I say, start in that $200,000 to $300,000 mark and start early. And to your point earlier about selling the business, I love that. I think if you can sell the business for a good amount of money, that's great. Let's not bank on that for retirement. I always tell my owners that let's have more than one plan. Let's have more than one option. It's not just every dollar that I make, I'm going to turn around and put back into the business, because no matter what, I'm going to sell it, and that's my retirement, right? There's a good portion of businesses that get listed that don't sell. And if that ends up being you, then obviously you have no retirement, right? So don't put yourself in that position. And then the last piece that I would add would be that fractional CFO, probably as you're trending $500,000 in revenue and above, as you've scaled it to that point. That's where you're getting to a place where some important financial decisions need to be made. You need some more insights into your numbers, and you're also going to get a good return on working with a great professional that is doing the part-time CFO role. It also becomes affordable, for you as you're, that $500,000 business, and you can get a part-time CFO for $1,500 to $2,000 a month. It's something that's affordable. And then obviously, as you continue to grow and scale, that number is going to go up a bit, but you've got more complexity and you've got more things to look at and need more help. So, and you can probably take that for a long, long time, up to, 15, 20 million. And then eventually you get to the point where you have a CFO, maybe even on site like a day a week, right? Again, a little bit more expensive, a little bit more involved, but it's not the cost of a full-time CFO yet. So you can really scale with that and just keep ramping up as you go. But those are the positions, that I think are really important to have on your financial team. As the business goes, you could switch from a bookkeeping firm to hiring an inside accountant. That's fine. And your CFO should be, directing that accountant if they have questions or need training or anything like that. But I think that's a good way to go about scaling your finance team, and kind of the points at where you should hire those people and get them in your life.
And I love how you categorize that into the different income ranges, because that, I think, helps tremendously for anyone who's listening. So thank you for that.
Of course.
Ryan, I usually ask my guests to provide some actionable tips for our listeners, but in honor of Small Business Month, I'll ask you to provide some tips specifically to those small businesses, maybe just getting off the ground. What else can you provide? Because you've given some, great information, but what else can you tell them, about getting started right and doing the right things?
Yep. Yeah, I think to start with, you've really got to evaluate, does my product or service fit in the market? When you're getting started, does it fit in the market, and is there demand for it? Sometimes that can be really hard to judge. Sometimes it can be really easy to judge. If you've got some new innovative product that nobody's ever put on the market before, you're in a brand new space, right? Versus if you're, a lawyer and you want to break off from a firm and you want to go do estate planning, it's proven, right? People need estate plans, right? So, but that's the first thing to assess. And you've really got to test the market and test your pricing throughout that point, and really look at the different profitability levels that you're going to have with that pricing, right? There's probably circumstances where you have a brand new product and maybe the demand for it is, I'm just going to say it's a widget and it's $30, and you're not making enough money to grow the business at $30, right? And so then you don't have product market fit, and long term, that's not going to be a success, right? Unless something changes with the product or changes in the environment, long term, that's not going to be a success. The other thing that I would say is, as you get into larger businesses, six-figure businesses, I am not a huge fan of budgets. I don't think they do much for us, right? You're setting a number, but it's really a restriction on spending. And a lot of times by the time you've hit your budget number and went beyond it, what can you do about it now? The money's gone, right? It's too late. So, for our clients, we're always going into the future and setting targets for where we want to go. I think for all small businesses, going through and setting those target numbers, they're not necessarily budget numbers, but setting those target numbers for where you want the business to go, super, super important. I would say if you're a startup and you've been funded, then maybe a budget and a plan for that money is more appropriate. But those are a few things that come to mind as I think about, really the small and kind of micro businesses that are really trying to get started. And beyond that, I would say, really just aim to keep it lean. Keep your expenses lean for a while. You've got to bootstrap some things to really get it off the ground and have that market fit and have those sales to really drive growth in the business.
Yeah, and that lean one, strikes a nerve with me because I've talked to a couple of folks. I had a young guy on the podcast. He started a business. I don't even remember what it was. Went and got a $3,000 a month office and all this stuff. And it's like, he ran out of money in the first 3 months.
Yeah.
Like, why did you need a $3,000 office? If you wanted an office, go get, a flex space or something for a couple $100, work from home, figure it out. But $3,000 office, and too many founders, want that presence and, all that kind of stuff that isn't necessary up front. So the being lean is a big one that resonates with me. So Ryan, thank you so very much for joining us today. I hope that our conversation with Ryan's got you thinking. Remember that moving from surviving to scaling your business starts with financial clarity and a solid framework. Don't forget to subscribe, leave a review, and share this episode with fellow business owners. And until next time, keep pushing forward on your journey to scale. Thanks again, Ryan. Take care.
Thank you so much for having me.
You've been listening to From Stuck to Scaled, growth strategies for small and mid-sized businesses, produced by Optocution LLC. For more information, tools, and resources, check out our website www.redefinepossible.co/podcast.